Hi, welcome back to Yahoo Finance Live on this Jobs Friday morning. Futures higher on the back of that better than expected June non-farm payrolls report. We see all three majors set for gains at the open on this final trading day of the week. Let's talk a little bit more about today's labor market report and everything else going on in markets. Seema Shah joins us now, Chief Strategist at Principal Global Investors. Seema, so let's just start with your impression of today's data, if it changes your thinking at all about the state of the U.S. recovery, or if it's really the kind of report that we needed to see, one in line with expectations after a couple of maybe sluggish months.
Yeah, I actually think this was the perfect labour market report for this time. It's just giving us reassurance that the labour market recovery is continuing. It looks like a lot of the supply constraints that have been weighing on the past few months are starting to lift. And it's not so strong that you're going to create even more worries about what the Fed's going to do next. So I think from a market perspective, this is exactly what we wanted.
Seema, what are some of the best sectors that you would gravitate towards after a report like this?
Well, I think, given it hasn't really changed the outlook very much, we still consider that cyclicals, given the reopening, is a strong place to be focused. So anything which is going to be benefiting from that reopening of the economy. But at the same time, we also recognize that the last few weeks have been quite difficult, with a lot of introspection about what the Fed is going to do next. I think that is likely to continue. And in that kind of situation, actually having some of those more growthy stocks, such as the mega cap tech, still continue to pay dividends. So I think, in terms of today's report, it doesn't really change much about the portfolio composition that we have been having.
Well, so let's talk a little bit about that rotation, Seema, because it's been such an interesting kind of phase in markets. We finally got this inflation data. Meanwhile, growth comes back in favor, at least in the U.S., growth comes back in favor. Some of those cyclical names are relative underperformers. What have you made of this rotation? How durable? Do you think this is a shift back to sort of what worked before the pandemic, or is this maybe a pause in a continued cyclical value type rally?
We continue to think that cyclicals will do well. I think that at this point in the recovery, there's going to be a lot of question marks, but the fundamentals are still really strong, and we would expect that to be showing through in earnings season. That's going to give a little bit more, a bit of a drive for equities going forward, and particularly cyclicals. I think for us, when we think about tech, it's not just, it works as a defensive positioning like we've seen over the last couple of weeks, but also so very good from a longer term perspective, right? These are the companies that have the strong balance sheets, the positive cash flows, the ones where it's a new economy. So, we think that you can do well by having some of those cyclicals, a little bit of those mega cap tech, and of course, don't ever forget the global diversification, those opportunities that are provided.
And we're just getting ready to have the opening bell on Wall Street. And I'm looking at some trending tickers here. Space, SPCE, a trending ticker on the platform right now. And news of Richard Branson flying to space before Jeff Bezos. And there we have the opening bell on this jobs report Friday. The Coast Guardsman of the New York Coast Guard Station is ringing that opening bell in celebration of July 4th. Good to see that. Looking forward to the July 4th weekend myself. Seema, getting back to you on the markets in the jobs report, you mentioned the Federal Reserve. And isn't the part of the problem here why we're not seeing a big pop in the market here off a report like this? It puts investors in a tough position. I mean, do they root for good data? Do they root for bad data? How do you see it?
That's such a big conversation. I was having a conversation with my colleague just before. How do we react to it? If it's a really strong number, typically in normal times you'd expect yields to go up, but actually, in this situation, does it create more concerns for the market that there's going to be premature tightening? It is quite a difficult time to read markets, which is why I think today's number, because it's not particularly strong, it's not particularly higher than expectations, is exactly what you needed. It gives that market a little bit more stability, that it doesn't need to start answering those questions that, to be frank, we don't have the data yet to have those answers. And it's going to be a couple more months before we get a better idea of where the labour market is going, where inflation is going. And we know the Fed is very, very much data driven. So it's still too early to make some clear conclusions.
Seema, our conversation so far has been very news of day, topic of day, where market's going, short term. But something you flagged for us in your note, and I'm guessing it's a conversation you're having both internally and with clients, is just portfolio construction and the old 60-40 setup, and sort of what should be in each bucket, and something, that comes up as a maybe, but maybe not quite yet part of that 40%, typically for folks who don't know the fixed income part, of a basic portfolio is maybe crypto fits into that part of it. And maybe it's real estate now. I mean, how are you guys thinking just about portfolio construction generally now that we're once again at the zero bound and fixed income isn't really doing anything, and everyone is once again, as we were 5-7 years ago, everyone's looking for yield?
Yeah, and it's very, very challenging for fixed income right now. With yields so low, it's very difficult to see where you're going to get those returns. So increasingly, we're thinking you need to be a little bit more innovative within that 40 section. Have a bit of treasuries, have a bit of mortgages. They will outperform if you get an economic disappointment. And certainly the last few weeks have shown us that the benefits of still having that stability. But at the same time, offset that with some of the risky stuff. So we're thinking about high yield, which still has a little bit of spread tightening to go. Something like emerging market debt, again, pick your countries very, very wisely. It's not a homogenous zone for emerging markets, but there's definitely a level of uptick. And then real estate. If you have any concerns about inflation, real estate performs really well as an inflation protection. It's diversified from equities and from bonds, and it typically does well in a stronger inflation environment where it's also accompanied by strong growth.
All right, Seema Shah, Chief Strategist, Principal Global Investor. Seema, always a pleasure. Thanks so much for jumping on. I know we'll talk soon. Have a great weekend.